Time now for Consumer Confidential with KTLA's David Lazarus.
He is joining us live. And David, we start with inflation spiking last month. And what does that exactly mean for interest rates?
Boy, it sure means interest rates are definitely going to be going up because, as we've been talking about, interest rates are one of the key tools that the Federal Reserve has to try to curb inflation. And inflation clearly is getting worse. According to the latest stats out there, the Consumer Price Index, obviously the measure of inflation in this country, up by 7.5% last month. That is the largest amount in 40 years, and it really shows what a bite is being put on ordinary working families. How big a bite? Well, a senior economist at Moody's Analytics crunched the numbers and determined that because of these rising consumer prices, the typical family is now paying about $250 more a month than it had been prior to this inflationary surge. Now, for higher income families, that might not sound like a lot, but for those in the middle and lower classes, $250 is the difference between just getting by and not getting by. So that's a very big deal. Also, Wells Fargo out with a new study finding that the middle class is being particularly hit hard. That because a higher percentage of their income goes to gasoline, and gas prices as of December were up by 50% from a year before. If there's a bright spot to all of this, it's that economists still think inflation will subside as the year goes on, but at the moment, financial markets are heading south, and we'll have more on that in the 1 o'clock hour.
Also, majority of business leaders really don't think that the interest hikes will help tame the inflation.
And this is interesting, Glenn, because this survey of CEOs by the Conference Board and the Business Council is a good barometer reading of how corporate leaders feel about where we're at and what can be done. And as you correctly noted, 3/4 of CEOs surveyed say they don't think rising interest rates are going to turn around these inflationary trends. The key reason is because the CEOs are focusing on other factors. For example, COVID-related supply issues and shortages. Also, rising wages, which can also have an effect on prices, pushing prices higher. So CEOs think, okay, it's fine that the Fed might want to move aggressively to curb interest rates, and the Fed is going to move aggressively, but the CEOs are unsure if that's going to have a big impact. Interestingly, when you look closer into the numbers, you see that about half of CEOs surveyed say they expect things to get better over the next 6 months. And while that sounds like a positive thing, in the fourth quarter of last year, the number of CEOs who expected things to get better in the next half year was at 61%. So that figure is going down.
And then let's talk mortgage rates.
Mortgage rates going up. Interestingly, the average rate for a 30-year fixed mortgage now at the highest level since before the pandemic. A 30-year fixed is going to run you 3.69% on an annual basis for interest rates. Now, what that means in practical terms is if you got a mortgage now, it would cost a little over $3,000 a year more than it would have had you gotten it a year ago. Now, these rising mortgage rates are a red flag for the housing market because already high interest rates are keeping some people out of the market, especially first-time home buyers, which is driving up rental costs because they're staying in the rental market. But look at this. The Fed hasn't even started raising rates yet. So if we're now at the highest mortgage rate since before the pandemic, once the Fed starts stepping on the gas pedal when it comes to rate hikes, and they will next month, that'll push rates even higher, which is going to create some turbulence in the housing market going forward. Back to you guys.